Recently, a number of our large Canadian banks have been downgraded. What does that mean? Well, if they were a buy rating by some investment firms, now they're a hold. If they were a hold, maybe now they're recommending selling those shares rather than holding them in a portfolio. And recently, Barclays, one of the banks, investment arm, has downgraded a few of our banks. And we have actually the charts of some of those banks. Royal Bank, as an example, we have a chart on that. You can see Royal Bank has hung in quite nicely. A bit of a head and shoulders pattern there for those technical analysts out there. You can see that. We also have Bank of Nova Scotia, which has been downgraded recently. And that has been a name that has been really in tough over the past year and a half. Great dividend. So I've been recommending it on this show. We've hit a low again into the mid to high 60s, down from a high. If you all recall, I said on an earlier show, I think it hit as high as $95 at one point, about a year and a half ago. And so Bank of Nova Scotia has been downgraded recently. And finally, TD Bank. As we talked about, TD Bank, one of the most shorted stocks, one of the most shorted bank stocks in the world today, along with Bank of Nova Scotia. And it's interesting to see that analysts continue to downgrade these banks. And so I wanted to touch on why analysts are downgrading these banks. They believe that if there is a recession to come, and many people believe that there is, if there's a recession in the US and or a recession here in Canada, our banks will be in tough. Keep in mind, banks are the bloodline of any economy. And so as we see or continue to see a slowdown of business, a slowdown of our economy here in our country, the banks will feel it. We will start to see less borrowing from the banks. We will start to see less trading activity, wealth management. Even though wealth management produces these reoccurring fees to the bank, perhaps portfolios will be less in terms of value and therefore generating less fees on those accounts. So the banks will be or will have some difficult times. There's also some estimations that at some point we will start to see more and more defaults on credit cards, defaults on loans, mortgages, etc. So I think that all comes together. And last but not least, if we see the US fall into a recession, as we know, Canada, largest trading partner with the US, we will definitely feel it up here. So that is the reason why some of these analysts are talking about downgrading our banks. In my opinion, I don't think we have to worry. Yes, it's going to be a bit of a bumpy ride, but as I said, if we get to the point where interest rates stop going up, if we can get to that point, and I think we are at that point now, I think just like all other businesses, banks will learn to cope. They will be able to charge more for the loans they provide. They may have to pay out more interest on some of those high interest savings accounts. So maybe it hits their profits a little bit, but I think over time, they will learn to cope like everybody else. And in the meantime, they're offering some great entry points. These banks are trading at really, really low entry points, whether you're CIBC, and a bank I haven't mentioned yet, a BMO, TD, a Scotia, they're all paying great dividends, and they all represent good entry points for those that are looking for growth and income. So even if you hear banks are being downgraded, you hear that they're being shorted, I think this is a temporary thing, perhaps maybe going to last a few months longer, maybe a quarter or so longer. But I think over the long term, you still want to own these names. They're still best in class. And living here in our country, you have 5 or 6 main banks that we all seem to do business with. And until that changes, which I don't think it will, I think banks are a great investment for those that can handle the risk and looking for growth and income.